Hello, everybody. Thank you for joining us for today's public webinar, Operating in an Emotional Environment. Just a few things here. For those of you that are new to us, I just wanted to point out where you can find our official YouTube channel here on our website in this black strip line here on our homepage at jimdeltontrading.com. And we release a week ahead video every weekend. So you may want to subscribe to that so you don't miss any. Sorry, YouTube right here, Twitter, X, whatever you want to call it right here. And if you'd like to get our emails so that you're alerted to when we have a course announcement, a free report or something like that, or our public webinars, please join our mailing list here. You'll also see here at the top, we've got our summer intensive featured up at the top. Our next intensive runs from June 3rd to 28th for the whole month. You can click here and you'll see the details on the summer intensive page here. And then we also got the schedule here that lets you know the class schedule. Obviously, these are posted in Eastern time and you will need to convert to your time zone. The intensive has a prerequisite requirement of the Foundation and Application of the Market Profile eCourse. Right now, we've got limited time discounted bundles with our early bird pricing through this Sunday, the 21st, I believe. And you can get a nice discount for purchasing more than one. And Jim is having a technical difficulty right now, so he will be right back. But I just wanted to point out the bundles that we have here on our website. You can also see if you have done an intensive with us before, maybe you don't have the Advanced Nuances eCourse, you can also get a discount on that bundle. And if you are somebody new and you want to do all three, you get a really nice discount for purchasing all three courses. But again, in order to join us for a live intensive, you have to have the Foundation and Application of the Market Profile eCourse as a prerequisite requirement. The only exception to that is if you have done an intensive with us before and we can verify that, then you can be grandfathered in. Otherwise, there's no exceptions. The reason for that really is because we found that we need people to have a certain amount of knowledge, and as you know, knowledge as Jim intended. And we had too many people coming in saying, I took trainings or I read the books or I saw YouTube videos, and it really was not enough. And this is something that it's over time, like, you know, a couple of years there. Jim, are you back yet? I think he's having a technical problem. Hold on one second. So just hold on a few moments here. Apologize for that, but looks like Jim's coming back in now.
Okay, Jen, we'll have to use your screen.
Okay, I'm here. Okay. Yep, we're on my screen right now. Your machine is still boot. Your programs are still loading up.
Yeah, it's a mess.
Okay, no problem.
Okay, so I need to see your screen.
Not a problem. I'll put my screen up here. So if you have any questions about what course is right for you, or you just have some clarification questions that you need with regards to our courses, by all means, shoot us an email at delton@jimdeltontrading.com or give us a call and I'd be happy to speak with you about that, okay? Okay, here's charts. Here you go, Jim. Can you see, Jim?
I can, okay.
Okay.
All right, I'm sorry about that. That's the second time it did that once yesterday, and it's the only time it's ever done it. Well, clearly, what you can see going on is the market's been shooting for this 50, 57, 50 level gap. That was that huge gap that goes back sometime. And most of these big gaps get filled. It's a tick or so short of filling it right now. But that's what the market's been doing. I think what's going on in this market overall is a little bit complex. While the market has broken down, has broken down, what has happened, I think, is the market spent the last month or so, a little over a month, in a trading range, and in that trading range, there was no indication to me whatsoever that there was any serious longer-term either trading money or investment money active. It seemed to be all very short-term trading money, back and forth. You know, there was no, it was up, it was down, it was up, it was down. And I think there's a complacency among the longer-term money, both from the investment side and also the longer-term trading money. Normally, and I think they've been pretty well fully invested. So when the market broke down, and we did get the downside breakout, there was no marginal money left to come in on the buy side of the market. But I still don't think they've come off the sidelines. So that puts a tremendous amount of risk in the current market. So clearly the market's focused on Israel. We know that. We can read all that news. But where the real risk is that it's not uncommon for the investment money not to come in when the market really starts to break down until the market's off 7, 8, 9%. If they came in, normally if they came in sooner than that, they wouldn't be long-term investors. And I have seen, from looking at the daily volume, I've seen no indication that any of that money has come off the sideline. So the concern is, if that money starts to come off the sideline, that could really put some downward pressure on this market. As I said earlier, I think the commodity trading advisors and some of the bigger hedge funds and family offices, I think they're pretty well full up. So there wasn't any spare buying power to keep the market from breaking down. But I think that money is also potential to come into this market. And the danger is, as we've said so often, that markets go down like an elevator and come up like an escalator. It's an old saying. But this market is getting, we've now filled that gap. So we're getting more serious on the downside. And I don't know this, what we got this afternoon, the next thing we're going to be looking at to see if we get continuation today. We've got, of course, the 20-year bond auction at 1 o'clock Eastern. And if for any reason, if that doesn't go well, that's going to put additional pressure on the market. So I think that's your short-term reference to be looking at. And of course, then an hour after that, you've got the Federal Reserve Beige Book, which covers the 12 district areas, the 12 Federal Reserve districts, and it's going to be important. And normally, I don't pay a lot of attention to the Beige Book, but this one could be important because there's a lot of concern out there about how long it's going to be before the Fed does lower rates. So I think I don't have much more to add today. I mean, the market broke down. We had a downside breakout when we came through the trading range that we'd been in for some period of time. The trend is clearly down. We've now gone down, and it looks like it's mechanical. It looks like we filled the gap to the tick, which is an indication that it's more short-term trading than anything else. And I still think it's mostly short-term trading. I don't think we've seen the evidence of longer-term money come in this market. And that's the fear that they do come off the sideline. They pride themselves on not panicking like we do as short-term traders. But I've been around a long time, and they do panic. They just don't panic as much. They get the telephone calls from clients, and at first they reassure the clients everything fine, but it drips on them. After they get multiple calls, they start to get uncomfortable, and the market goes down, and that's always another shoe that is possible to drop in here. So I don't have much more to say than that. You've got the next thing of course, is going to be, how does the 20-year auction go this afternoon? If there's any hiccup in that, that could put more pressure. And then of course, then the beige book. This is a very short presentation, but I don't think there's a lot more to say in here. Let me take some questions, please.
Okay, somebody's asking what money on the sideline?
Maybe I misspoke. I don't think there's a lot of money around. I mean, I hear talk about, the billions of dollars in money market funds, but I think that there's not a lot of money around, because I think the long-term money is fairly fully invested. I think a lot of the hedge fund and the CTA money is pretty fully invested. So I don't think it leaves a lot of cushion. And I think that leaves open the potential that money gets nervous. We're down enough that it starts to make them nervous. And that's why we sometimes see that these markets are down a bit before you really start to get the acceleration to the downside. Okay.
Okay, what does Jim think about the volume today?
I haven't seen a lot of volume in here, for an awful long time. Today, one of the dangers in this market, I'm going to go back. Jen, show the 15th, please. Start from the high of the 15th. Okay, so the high in the 15th, the 8-period high, was exactly at the overnight high. That's where the selling comes in. That's not a sign that it's longer term money. That's when it comes from those exacting levels. That's more of an indication it's shorter term money. Now, if you come down from the high to the low of the 15th, you'll see how thin that market is. Jen, can you bring it down so we can look at the low of that market? So you see how thin it is, and you got a big open spot. Usually when that happens, that's usually shorter term money, and it's usually very emotional money. And when the market gets too short, that can actually provide some support for the market. Now if you now come over to the right and look at today's auction and how thin we are from today's high on down. Jen, can you look at from today's high on down for me? Okay, you see that's also very thin. So the danger in here, we filled the gap, but I think the danger is that it's mostly, at this point, it's mostly short-term money. And I think that's the weakest money. And I think you've got to be very careful, because one of the risks that we fail to recognize sometimes is when inventory is too short. Okay, other questions?
Okay. The monthly time frame, one time framing up, has been breached today. Actually, we're trending down now. They said on Monday, the 15th, EF had the same high at 51.8550. Is that an indication of weak selling, but price did not come back and take it out? How do you see this?
Well, I see. Well, first of all, you said we stopped one time framing on the monthly today. I used the June contract. On the June contract, it stopped a couple of days ago, so that did turn it down. At least I have it. I have the auction turned to the downside. Because I have the daytime, the daily turn down, the weekly turn down, and then I got the confirmation of the monthly here the other day. But I still, even though that's happened, I still think the biggest risk in this market, of course, we know Israel's a wild card. We don't know what's going to happen and what the market's going to do from that. If what they do is mild, you can get a huge relief rally. If what they do is more aggressive than the market, was anticipating, of course, it can put another leg to the downside. That's a lot of uncertainty out here. But I think the real danger in here is that short-term inventory, and I think most of this selling has been by the short term. I think it's very, very short. And that can always be an explosive situation. Okay, what else? Anything else, Jim?
Sorry, I was on mute. Why do prices frequently need to move up before they go down to new session lows?
It's a constant. The market functions through a continuous two-way auction process. So inventory gets too short, then you've got to rebalance it. Inventory goes up, gets a little more balance, comes back down again. But it's a continuous two-way auction process. That's the way the market distributes bids and offers, and that's its continual search for what is really the fairest price. Okay.
Okay. Does Jim have any thoughts on the bond auctions and the 20-year that ends today at 1 p.m. Eastern?
No, I don't. No, as I said, I think it's going to be highly dependent upon if that auction, if there's no shock in the auction, that won't have much of effect here. If that is a poor auction or an exceptionally good auction, it could give us a little pop in this market. I think the biggest danger is that there's something wrong with the auction, and we've had that. Usually, I don't follow the auctions. I used to, but recently we've had a couple of times when the auctions have not gone smoothly, and it has put a little hickey to the downside. But no, I don't. I don't know if they backed it up enough to make it a good auction or not. And of course, and then following that will be the beige book an hour later. Okay. Anything else? I know
Yes.
it's a very short presentation this morning, but I don't want to make anything out of it that it's not.
Would you say anything more that speaks to our title, operating in an emotional environment?
Well, no, I would. I mean, that's what I said. When I look at the 15th and how thin that was from the top to the bottom, and I look at how thin today is, that is usually an indication of very emotional selling. And if you think back, when you make decisions that are emotional, are they good decisions or not? Usually they're not our best decisions. And I think that's the concern that I have in this market right now. Is the market going down? Yes, certainly the market's going down. We had the downside breakout. But I think inventory is exceptionally short. I think it's exceptionally short because of the emotion. Does it have to be corrected? No, but I think it's a risk that you certainly want to be aware of. Okay.
Okay, so I guess more than one person actually has asked a similar question, that the CME isn't publishing the settle till the next day. So where are we getting it? Usually, I just put the settle pre-market when I'm looking at what happened at the overnight and to check the overnight inventory. But Jim, has it been like an issue for you?
Not
Or do you
really.
just look at it in the overnight, you're just
I
looking
don't.
at it pre-market as well?
I don't. I don't obsess over. I mean, I put it in there because everybody wants it, but I don't obsess over a single number. I look at a much broader picture of what's going on in the market. Okay.
Okay. Why is short-term money such a concern? Wouldn't long-term money selling be more concerning?
Oh, long-term money is more concerning. And my concern, the point I'm making is that I don't see any evidence that the long-term money has come off the sideline and has started to sell. Nor do I see it from the hedge funds. There was, the hedge funds and the CTAs, as the market was going up. And that's the concern, that there hasn't been selling from there. So that could, if the market holds on this lower level, that money could get nervous and that could come out. And that's why it's not uncommon that when you see a market go down, a market so often goes down so much faster than it goes up. And the reason is that they hang on later. Remember, long-term money makes their money by time in the market, not by timing the market. And they stay complacent too long very often. And when all of a sudden they start to break, it's kind of crescendo to the downside. And it's not uncommon to get a few days in a row where the market just, streams very fast lower because they all start to pile on and there's no buying underneath it. We saw that a year ago, June. They took the market down in 3 or 4 days, and I'm just unbelievable. And then all of a sudden, to come back up, and a few weeks later, everybody's talking about new highs. It didn't make it, but it's that craziness that goes on. It's not a very orderly process. Anything else?
Yes. Do you see any obvious weaknesses above?
Oh, as I said, my concern. Clearly, the market's going down. Clearly, we have a downside breakout. Clearly, the trend is down. But the weakness above I see is that the short-term inventory, in my opinion, is exceptionally short. That is always a potential powder keg. So I think you want to make aware of that and just keep it as a safeguard, because part of the risk a lot of times people don't appreciate when markets are too short until it's too late. Everybody talks about it after the fact. But I spend a lot of time assessing, is it short? Every night when I do my preparation, I'm looking to see how short the inventory is. And I think the inventory is exceptionally short. Now, they're not always wrong, but when they are wrong, you can get some awfully fast moves in the opposite direction. Short covering moves very quickly. Everybody panics and, nobody's selling it to them. They just let it go up. Okay.
Okay. How do you determine how short the market is?
Through observation. I mean, you look how thin the market is. When you see the market's thin like that, you just know from experience that's emotional selling. What's the market normally? If it's a normal decline, the market goes down, it moves sideways, you get some balance to it, then it goes again, and then it balances again. When it's going down in a healthier manner, it's more of a stair step manner down. When you start from the 15th, this hasn't been a stair step, it's been straight down. And usually that's an indication of very short inventory. How short? I don't have any way to measure that, but I can see from experience that it's very emotional selling and it's probably excessive. Anything else?
Yes. Okay, are there any anchors or predictors for how the long-term money will act?
Nope. No, there's no, I mean, trading is an art, not a science. Trading is an art, not a science. But remember, the people that run the long-term money, they're human too. They don't panic as often as you and I do, but it drips on them. And in a way, as one starts to sell all of a sudden, then the others start to sell. I mean, I ran an institutional desk years ago, and I've watched this phenomenon over the years. They pride themselves on being calm, cool, and collective until all of a sudden panic sets in, and then it's hard to tell them apart. Okay.
Okay. Can you comment on what confirmation might look like in the daily time frame if today's momentum reverses to the upside?
No, you'll just see the market will just go up very, very short covering. If you ever see short covering goes up very, very quickly. Because once it starts, nobody's going to sell it to them. When it starts going up, the bids and offers starting to widen out, and the market's thin, and you'll just see kind of a panic move to the upside, and it will move very quickly. There's
Okay.
no magic. There's no magic indicators. So much of people are always looking for the magic. It's being involved in the market and understanding how markets work. And you look at markets long enough. As I say, clearly it's emotional right now because nobody knows what Israel's going to do. But when you look at what the action of short-term traders, remember FOMO, everybody's afraid of missing out. And I see how thin these markets are, and I just think they're dangerously short. Okay, what else?
Okay. Any significance to a 7% drop before larger players get involved?
No, I have just found historically it can be, 6, 7, 8, 9%. Remember, long-term, as I said, I'm repeating myself, but long-term money makes their money by time in the market, not by timing the market. So, and, for years, the market's been up and they've done well. But, the market's starting to, start to come off a bit now. We do have a downside. We do have a downside breakout. We went over a month with the market moving sideways and no indication of any serious participation at all that I could see. And that complacency can come to an end. If you remember when the market hit the low in the 80s following the Lehman Brothers crisis, I mean, the selling by the long time frame was absolutely huge. Absolutely huge. I forget how many billions it was. I want to say it was 80 billion or something like that. And that was it. They were the last ones. They were the last ones to sell, but they finally panicked. That put an end to the market, and it's been up ever since. So again, is it predictable? The timing's not. It feeds on itself once it gets underway.
Okay. What quantitative data do you look at for short and long-term inventory?
I don't look at quantitative data. I look at the market. I look at the market every day, and I look at the way the market is traded. Again, people do it different ways, but I look at the way the market traded. I've been doing this for 50 years, and I watch the structure of the market itself. All right, let me say thank you very much. And like I say, the next thing we'll watch is what happens on the 20-year, followed by the Bayes book this afternoon.
Okay, thank you very much. Like I said, early bird pricing for the intensive and our limited time bundles end this Sunday. So if you've got any questions, by all means contact us or shoot us an email. I'd be happy to speak with you. And like I said, just a reminder, please do not sign up for the intensive without having the prerequisite requirement of the foundation and application of the market profile eCourse. Thank you so much, everybody, and we'll see you next time.